With a title like Positioning for World War III, it's important to begin with some context. Geopolitics has always shaped financial markets, but today tensions appear to be accelerating. From the war in Ukraine to rising tensions around Taiwan to the growing instability across parts of the Middle East, the global landscape is becoming increasingly fragmented. Whenever geopolitical risk rises, the markets will respond. And in the short term, that response is usually fear. Where volatility increases, capital moves towards perceived safe havens, and risky assets experience a sharp sell-off. However, history shows us something really interesting. While geopolitical shocks create uncertainty in the moment, markets tend to recover relatively quickly and in a very strong manner. So capital doesn't just disappear, it simply moves. Institutional investors reposition towards the sectors and assets that historically benefit the most from conflict and instability. And 9 times out of 10, the investor caught on the wrong side of that trade is the retail investor. Rather than speculating on individual headlines, today we want to take a step back and explain how geopolitical tensions shape financial markets and how investors can think about positioning their portfolios. On the agenda today, we'll review previous war cases and broader index movements over a 12-month period. Then Mitchell and I will talk through sector by sector movements. We will then analyze how commodities, precious metals, and cryptocurrencies behave and suggest how viewers can position their portfolios. Mitchell, would you like to provide us with some context on how the markets are responding and I guess where we are today?
Yeah, so as of today, Wednesday, March 4th, the markets have been pretty volatile as we've seen. The initial shock reaction to the geopolitical problems was down, oil spiked up, and just kind of the typical reaction that you would see. So I just wanted to run through a bit of like what the entire geopolitical landscape is. So obviously the big headline right now is the Iran war with Israel and the US. The US and Israel have kind of just been bombing Iran right now. They took out the Ayatollah. So it looks like there's going to be a regime change there. So the markets will price that in over the longer term. But some other context, obviously we still have the Russia-Ukraine war that we're not really seeing as much in the headlines, and China, Taiwan are kind of always a pressure for the supply chain sort of things. So right now we're kind of in a world where energy, trade routes, supply chains are really becoming geopolitical tools, and there's going to be a ton of disruption right now. So I think if we just wanted to walk through that and kind of explain to our viewers what's kind of really going on in depth there.
Perfect. So at this time, we'll jump into the graphs we prepared today. Firstly, I would like to take a look at how the S&P 500 responded when the US invaded Iraq and the war started on March 20, 2003. So what we can see here is the markets actually opened green and closed 2% higher a day later. And the S&P 500, it did experience a little bit of a drawdown, but when we sort of step out into the more medium term view, 365 days later or a year later, the S&P 500 was up 30%. So interestingly enough, this was essentially the start of a bull run that lasted for 5 years or so. And the market, it obviously saw that initial fear and risk and it sold off a little bit, but very quickly the market responded. And investors who sold out here will be ruining their chances of having, gained 30% within 1 year just by sticking in and sort of bearing for that risk. Another key example of this, we are going to jump into the Euro Stocks Top 50. So at this time frame here, this is the 24th of February 2022, and Russia have just decided to invade Ukraine. Okay. And what we see here is, okay, initially the index fell 12% over 13 days. So a pretty sort of measurable material drawdown. However, within 20 days, the index returned to its prior level. Okay. So this sort of means that after 20 days, the market essentially forgot about this invasion and had completely moved on from the fear. Okay. And 365 days later, the index was up 10%. So the sad reality here is that markets, they don't really care about wars or geopolitical conflict. And that's what we can prove from these graphs. And, war means more spending, which is good for the economy and things quickly bounce back. And I think we have another example here we found this on X, Seth Gordon posted. So thanks very much for doing the research there. Mitch, do you want to lead us through this one?
Yeah, absolutely. So as you can see, I mean, you have the Korean War, Cuban Missile Crisis, Cambodia invasion, the Iranian hostage crisis, US enters Gulf War, Afghanistan War, Iraq War, and kind of US bombs Iranian nukes, which was more recently this past April. Um, Again, green across the board. The only one that wasn't was just an outlier was US when they bombed Libya. I don't know if it was something geopolitical at that time that where the market was already high. It could have been a multitude of factors, but the key main point here is that whether we like it or not, war tends to be bullish, and there is that quote that Wall Street uses, which "buy the invasion," right? Because you usually get that initial shock value where the market kind of prices in the disruption, and then as we see the benefactors afterwards, long-term contracts are signed, whether energy prices stay elevated or not. There's a lot of different factors, right, that can really benefit the economy. And in some circumstances, if there is a drag on the economy, sometimes they cut interest rates going into war time periods, which can also stimulate further growth, which definitely has a factor as well.
Yeah, yeah. And so what we looked at there, what we've proven is that sort of broader indexes, they tend to be sort of unconcerned after a period of 20 days, 30 days, as that image showed. So what we want to do is take a step back from looking at it by a broader index, which I guess tracks an entire economy, and we want to just look at it sector by sector. So what I'm sort of suggesting is we sort of go through the winners and the losers. The bad news is so sort of bad news in the market, I guess that just means red days, okay? And good news means green days for the market. However, when war breaks out, roles can sort of be reversed here a little bit, and conflicts sort of the markets no longer focus on risk reward plays. The markets are focused on who gets paid, who gets disrupted, and essentially who the winners and who the losers are. So, with that in mind, the first sector I'd like to touch on is the defense force sector. Okay. So, the likes of physical arm dealers, aerospace, unmanned drone systems, even cybersecurity.
Yeah, definitely. I mean, we got tons of different names, obviously from the major companies. You're gonna the big benefactors are gonna kind of be Lockheed Martin, Northrop Grumman, Raytheon, BAE Systems. So anyone who really modernized defense and kind of makes drones, AI systems, again, cybersecurities, tanks, planes, all that good stuff. And then I just wanted to touch on some energy plays here. I know, Sean, you can go back and kind of go a bit deeper, but just what's interesting about these energy names like Exxon, Chevron, even from Canada, if you want to look at Canadian Natural Resources, Suncor, Cenovus, a lot of them were kind of setting up and breaking out before the war kind of happened, which they've ran now, and maybe some people would say they priced it in. But as you said, it's important to look at long term cash flows and who's going to benefit from that. So I think that's just a good point to kind of touch on there.
Yeah, I think that's the key thing here, right? Defense is very much a cash flow story. It's not a headline story, okay? The first spike is usually sentiment around any event, and then sort of bigger, more material moves usually is sort of multi-year contracts, procurement cycles, and you got to think duration of contracts rather than today's missiles. So I guess what we're looking for here is you'd want to be focusing on companies that have that sort of exposure to long-term government contracts. And one of the key things is that the U.S. Defense Force spend in the previous 2 years was about 850 billion. This year, it's forecast to be 901 billion. And Trump went as far as saying for 2027, he wants to push that out to 1.5 trillion. Okay. So this is long-term predictable revenue that companies know that they can continue their research and development. They can up their production ramps. And another key point there is that Trump said he was looking at, I guess, limiting capital returns to shareholders in these companies. So he wants these guys to go all out. He wants them to increase production, forget capex, and just really be able to prepare America now. Okay. So that sort of gives you the initiative that is in the US and sort of where to focus if this long term spending does mature. Okay. And I think another key area here, two others in the defense just before we move on. Firstly, you have the unmanned drone systems, okay, and war is increasingly becoming more technology led with unmanned drones, anti drone systems, sort of that can protect and penetrate borders, okay. And some drones have run pretty hard over the last year, but that's an area I'd have key focus in as well because I think we're starting to see less soldiers sort of go out in the traditional sense we would have seen in war times. And then also cybersecurity, I think that's a big one, okay? Because if you think about it, any conflict rises the probability of cyber spillovers, and that will sort of shift budgets from nice to haves to must haves, okay? Because if you think about it, the damages of a cybersecurity attack, they can target grids and electricity, they can target infrastructure, logistics systems, and sort of even hack private information around private war strategy and stuff like that. So I think that's becoming a must have opposed to a nice to have previously in the past.
Yeah, well said. I think there's one thing too you just reminded me of, so thank you. When we think about, and this might be a bit off topic, but when we think about the war scenario and the new IPOs that are coming, Anduril is a really big one. Okay, so when we looked at SpaceX, all the space stocks kind of ran into in anticipation of it, and the SpaceX IPO is coming this year. Well, Anduril is a really big defense company that is private right now, run by Palmer Luckey, and I think their valuation has jumped over the last year from 30 billion to 60 billion. Now, if that same sort of anticipation and hype money flows into that side of the market where it's defense, I could definitely see some of those drone names and some of those other names again catching a bigger bid in anticipation for Anduril's IPO because I know Palmer Luckey's a big name. He's a pretty polarizing figure in the media. Some people say he's controversial, and he's doing a lot of really futuristic things in the military that he thinks the military kind of needs to get back to. So it could be really interesting. And again, there could be some explosive moves in a lot of those names.
Fully agreed. Good pun there on explosive names. Where I'd like to jump into next is probably sort of the loser side of the argument. When you think losers, you got to think cost inflation, can't pass on this price. Um, but also the leisure, the travel, the airline, sort of cruise ship industry, okay? If these operate in a region that has been completely disrupted, business logistics, airlines, cruise ships, these companies are temporarily impacted. They could provide a strong rebound play. So I think one of the key things here is you got to think of any of these buys as what's your time horizon? Is it a long-term buy or is it a short-term buy? Because there's probably going to be some pain in the leisure and travel industries, stuff like that, around times of geopolitical unrest. But over the long term, they present that potential rebound play where you can make money that the market is pretty much going to guarantee when it returns to a certain level of volume and activity.
Yeah, definitely. I mean, you saw the initial reaction, I think, of Delta and a couple others. Maybe American Airlines dropped, I think, 6, 7%, and they were the worst performers in the S&P. Again, fuel costs are rising sharply, so their most recent quarter coming up is going to be probably a bit affected. There was, I think, 50 or 60% of all flights were canceled kind of to that Middle East area. Definitely not going into, obviously, Iran, Dubai, any of those other Middle East nations. So, again, short term pain could create an opportunity. As well, what you could think of too is that if the US GDP is still growing strongly, again, the ISM manufacturing data came out again today, was very, very strong. So that means there's an expansion in the economy. A lot of that could flow into consumer spending. The consumer is still pretty resilient. And then we could see volumes pick up domestically for airlines as well. So I wouldn't be too worried. In the short term, maybe some pain, but again, long term, more side opportunity.
Yeah, the only sort of medium term concern here is the rising energy and oil prices, right? Because if those prices start to creep up and customers don't want to pay the extra fare, I mean, business is going to go down, their margins going to be squeezed, they're going to have less sort of a loading percentage on the plane, they're going to fill less seats. So on that, it's probably a good point to sort of transition into energy, oil, gas. Just get your thoughts on that, what you see across those sectors.
Yeah, so interestingly enough, obviously, we're going to touch on the Strait of Hormuz. So I just want to go back and kind of really explain to everyone what it is. So it's basically one of the central areas that what's the biggest and most important oil choke point in the world, right? So all the shipping tankers go through there. It has roughly 20% of global oil supply flows through there, which is 17 to 20 million barrels per day. And it's basically a shipping lane through Iran and Oman. I think I'm saying that correctly. So, and at its widest point or its narrowest point, it's only 21 miles wide. Now, the major exporters that rely on it are going to be Saudi Arabia, Iraq, UAE, Kuwait. Qatar and Iran. Obviously, any threat of disruption there is going to keep oil prices elevated, and that bleeds into the oil tankers and shipping. So daily rates can move from 30 to 40,000 per day all the way up to over 100,000 during any sort of disruption there. Some names to kind of keep in mind: Scorpio tankers, international seaways will all kind of be affected, and we've already seen them kind of front run that. And then just some further oil market dynamics. I mean, the global demand is roughly, I think, 100 million to 102 million barrels per day, and the spare capacity is only 3 to 4 million. So it's pretty tight right now, and prices are currently around 75 to 80 bucks a barrel. So if it gets pushed to 100, look out for oil companies because they'll probably do quite well.
Yeah, I think the key thing here on energy, oil, gas, whatever it is, it's the bottlenecks within the industry. Okay, you brought up the Strait of Hormuz. It's if production stops in any of these areas, or if the logistics, you can't get through that strait. Okay, and it's the key bottlenecks that, if you've invested in those companies, that create that sort of um that that price increase ability. Okay, so it basically, even if nothing happens, the market often prices in the probability of disruption. Okay, and so for energy companies during times of these geopolitical tensions, they tend to generate more revenue. This translates to more profits, and it translates to a sort of higher share price. So energy markets are largely reacting to supply risk. Demand will stay the same, yet if the lower supply, companies can charge more. That's essentially how it works. And if you think about it, during the Russian-Ukraine war in 2022, oil prices briefly hit 120 a barrel. Okay, it was only a couple of weeks ago we were at like 65, and so Exxon and Chevron at this time, they reported like record profits. So it's just, you got to think about, you know, where is the bottlenecks, and sort of how to invest in this strategically. And I think another thing driving up the prices is, it's not just the supply fear, it's the strategic stockpiling. Okay, it's countries and companies trying to buy 2 3 months in advance with the fear of, well, we need to buy more now because we don't know if we can get it later. We don't know if the production's going to fall, and we don't know if the logistics is going to be there. And then the final thing really to say is, the reason energy prices, energy stocks will sort of perform well is sort of, during this time, defense and logistics, the demand for energy and oil increases. So if you think fighter jets, naval fleets, armored vehicles, these all have to have more oil and energy in order to fund all this sort of defense movement. So they're just my key thoughts on it there, and sort of what you need to factor in.
Yeah, exactly. And I think what we saw from the markets as soon as Trump put out a tweet saying we could fight forever, we could go for a long time, um, oil oil peaked right up, right? So if they're not worried about the length of the war, that's something I would also keep into consideration because as that drags out, again, like you said, more demand for oil, bottlenecks. You saw natural gas spike up, and then what the European ECB came out and they just said, "Hey, we're ready to react with rates, whatever we need to do." So that's definitely a sensitive point, especially that you still have Russia, Ukraine fighting, and Russia's obviously a big natural gas supplier to the world. So just all
Yeah.
really tense situation all around there.
It's an interesting point there that you said this war could go on forever. We can fund that, but he also came out and said this war should have been 4 weeks, and we solved it in under an hour. Okay, so just take Trump with a little bit of pinch of salt there. So
Yeah.
when looking at all these energy investments, you can also consider alternatives, like not just oil, but you can look at pipelines, storage companies, and even alternative sources like uranium and stuff like that. So
Yeah, exactly. And again, the bottleneck is already really, really tight with AI and data centers, right? So that structurally, just that alone is already putting strain on the market. Now you add in anything else, and there's not a lot of wiggle room. So definitely keep an eye on the energy sector.
yeah. Mitchell, another area I'd like to touch base on: precious metals, gold, silver. I'd also like to get your thoughts on mining companies. Where do you see these playing out over the next, 6 to 12 months?
Yeah, again, gold and silver have run really, really hard, and I know you want to touch on that, so I'll let you talk about that. But just they're safe haven assets. Seeing geopolitical crises, you've seen Druckenmiller come out and say we have a position in gold, and I know, um, I, who is it? Soros has some gold, and Dalio again, Bridgewater, whether he's there or not, they had some gold too. So I think they just kind of have it there. in case there is geopolitical unrest and gold did spike up. Again, it's flat on the week because that's probably a testament to kind of how far it's already ran, and the market could have already been pricing it in. But a lot of these miners, a lot of these companies have been on such a good run over the past year, right? They've been up 100, 200%, and they are more profitable. And as the longer gold and silver stay up there, their multiples will expand because earnings are going to come through and they're going to be nice and strong. So I know you wanted to touch on that and kind of your thoughts there.
Yeah, so my initial thoughts on gold, silver, mining companies, precious metals is when people stop trusting narratives, okay, when there's geopolitical unrest, they revert back to gold as the oldest settlement asset on earth, okay? And we previously discussed gold and silver as a run to safe haven um, during times of uncertainty. And it's that pre-dollar currency that the world is familiar with and is sort of a good limit to strong inflation hedge as well. So my thoughts initially on it are gold and silver is run a little bit parabolic, okay? Silver especially, it's sort of in that euphoric range, right? But like if you think about gold, where we are at the moment, I think we're trading around 5.4, 5.5 per ounce. The global stage is sort of priced in the tensions around Ukraine, Russia, China, Taiwan, the USA, Venezuela, the USA, Colombia, the USA, Iran, sort of Middle Eastern tensions as well. So you're sort of looking at it going, how much further can it go from here? Because there's been a lot of central bank buying over the last few years, which has driven it up. And you're looking at it going, okay, if I was buying this at the time of Ukraine, Russia, where it's maybe $1,800 per ounce, that has a very strong risk reward profile. But where it is now, it's sort of 5.4, 5.5. You're sort of saying the return profile is narrowing. And even in the last week or so, we've seen gold and silver sort of pull back despite this additional, geopolitical unrest. So it's a bit of a hard one to understand. And what I would say is my play in the precious metals right now wouldn't really be gold and silver. I'd probably more so look to copper, nickel, palladium, and even investing in mining companies who are more focused just on a broader range of metals rather than gold and silver, because I think they're probably a little bit oversold and there could be a little bit of a correction there.
Yeah, again, bottlenecks, right? So obviously copper and Drunken Miller again, sorry to reference him twice here, but he's the GOAT for a reason. But he was saying they're structurally long copper, right? They see the supply chain being really tight and they see upside there as well. So and there's no new supply coming online too, which is with data centers and EVs and all these things and um the precious mineral
Industrial use.
yeah, all the industrial use is just kind of upticking, right? So I don't know if you wanted to touch on crypto, or you wanted me to take the reins there.
Yeah, would you like to lead us out in crypto?
Yeah, so really interestingly enough, obviously, Bitcoin and Ethereum have been under pressure as of the last 7, 8 months here. But when Iran originally was struck, Bitcoin and ETH didn't move at all, right? So you saw Bitcoin, I think, settle around that 63,000 region and then jump up to, as of today, I think 73,000, right? It's outperformed actually every major index, gold and silver. So what's interesting there is either Bitcoin and Ethereum could be seen as a way to transact. When we saw Russia and Ukraine happen, a lot of the Russians, when banks were frozen, they need to get money out, right? And when you need to transact and when you're a billionaire or you're an oligarch or whatever, that's just a payment rail that can't really be traced. Secondly, with that said, it could also be hinting at the war's already priced in, right? You could say, okay, well, they already think US and Israel are going to win. Maybe that's some prosperity in the Middle East. Again, liquid assets like crypto and ETH would really react to that kind of liquidity. And then at the same time, if there's a macro growth drag from maybe some of the tensions over there, you could be seeing rates being cut or raised just depending on what happens there with the price of oil, but Bitcoin could also be pricing that in. So I just think crypto is really interesting right now. We've been looking at it in the group. Obviously, it's had quite the correction, and we're bullish on both Bitcoin and ETH, and I think they're reacting quite well, and probably a bit of a surprise to what most people thought was going to happen.
Yeah, yeah, fully agree. Couple of things on it. I think Bitcoin has always wanted to be that digital gold, but only in sort of real time during war and stress do we see it's trading a bit more like a high beta asset, okay? And it's not really that safe haven, so it's hard to classify it in there because of the volatility, okay? But one of the key things that I liked from it is previously you mentioned Ukraine, Russia. Ukrainians, when the banks collapsed and ATMs weren't funded and nobody was in the banks and, they couldn't actually get physical cash to pay for food, to, buy petrol and gas and do whatever they needed to do to survive. Individuals were able to transfer straight to the ledger, Bitcoin and Ethereum. They were able to use that as a way of settling transactions. So I would argue that Bitcoin hasn't proven itself as digital gold or that safe haven asset, but there is a level of insurance in it that you're able to use it, and people will accept it. Now, the range of the price and stuff like that and how it trades will be volatile, but it is a level of insurance that could get you out of a difficult position. Um, where I would sit on it is I think Ethereum is probably a better long-term play right now. I think if you buy Ethereum around this level in 5 years' time or 3 years' time, you're not going to be down, right? I think it's got a lot more. I think it's got a better risk reward profile from where we are now with against Bitcoin and definitely across the other riskier crypto assets. Okay, so that would be my opinion on it.
I was just gonna say, obviously, ETH has that other use case of being built on the blockchain and having payment rails go across it, right? And I think that's a big, big thing. I know Tom Lee has been pushing that, and a lot of these treasury companies that came about were really jumping on that thesis where ETH has a bit more of a use case in the financial world and the banking industry, and they want to kind of remove that frictionless sort of payment. So I know, again, if you're looking for just another scenario of why it might work better than Bitcoin, that's one of them, and 2,
Yeah,
Bitcoin kind of dictates all prices, but as that money flows down, smaller market cap, ETH usually tends to outperform on the upside, or at least did in the past. So just something to keep an eye on there.
yeah, no, very, very good point. Next area I'd like to move on to is sort of dollar, the US dollar and its dynamics and how it moves during these geopolitical tensions, right? Because it's not very straightforward, right? So every time the world gets more dangerous, global investors ask one question, and that question is, where is the safest place to park capital? And more often than not, the answer is the US dollar. And so when everyone's talking about the de-dollarization movement from the BRICS, then they hit a crisis and the world just scrambles for dollars. So the big question here is, how does the dollar behave over the short term? How does it behave over the long term? Because it's not really black or white in terms of a yes or no or strong or poor. Okay. So you got to sort of break it out into short term and long term. And I think in the short term, the dollar has showed that in the past it tends to strengthen. Um, because it's seen as a safe haven asset, it's also the global reserve currency, and global trade and debt are priced in USD. So when risk spikes, institutions sell off emerging market sort of currencies and assets, and they go into that safer currency, okay? And that's because if their debt is denominated in USD, they need dollars. If trade is denominated in USD, be it oil, they need dollars. So there's this greater demand for dollars, okay? And a key example here is during the Russian invasion of Ukraine, the dollar surged to a 20-year high. So that's just a key sort of indication of when there's a time of war, everyone wants dollars because it's that more acceptable and you can settle more transactions in it. And I think that holds for the institutions, banks, corporations. So broadly speaking, in the short term, it tends to do quite well. And again, because of that oil price, everyone needs to buy oil. But over the long run, when you break it out a bit more, wars can pressure the dollar, okay? And it comes down as the war lingers out, governments increase spending, the fiscal deficits expand, money supply may increase, and there's just higher debt. Like no one comes out of a war with a lower debt profile than they went in, okay? They need to fund that war. And so my example here over the long term is if you look at the Vietnam War as an example, where the US and Vietnam were at war. That lasted 20 years. And with debt ramping up, fiscal deficits exploding, the dollar devalued. And this sort of led to the end of the Bretton Woods monetary system where the dollar was pegged to gold reserves because they just printed so much money that they could no longer hold it in reserve and peg to gold. So I think that's an example of how the dollar weakens. So if someone was to ask me, how does the dollar perform when there is war and geopolitical instability? I'd say short term, good, long term, not so good. So that's sort of
Yeah.
my approach on it.
Yeah, you kinda hit the nail right on the head there. I think roughly 60% of all global foreign exchange reserves are held in dollars. Most global commodities are priced in dollars, and the largest, most liquid bond or most liquid, sorry, bond market in the world is the US Treasury market. So, a lot of money flowing through USD. And again, you kind of explained it perfectly. So the two-phase pattern is just phase one, crisis phase. Everyone kind of freaks out. They assess the situation, and then the short term, they say, "Okay, we're going to dollars. We're fine there. We're at like capital all flowing there. It seeks safety and liquidity." Again, that's another thing, right? You want it to be liquid so you can move it in and out, especially when you have large sums of money. And then phase two is the financing phase, which again we saw in World War II. Government spending exploded, and with the US already being in a pretty delicate fiscal situation with their debt to GDP being so high, I don't think they really want a prolonged war too. And if you just kind of think about that, like, I don't know how much more fiscal spending they want, right? Because if gold's running before this and then gold's now running because of it, what happens if they actually do have a prolonged war, right? So, just definitely something to keep an eye on the dollar, but in the short term, it'll be strong and then it'll kind
Yeah,
of taper off, I would
a
accept.
sensitive situation, the longer it plays out. Um,
Definitely.
so, Mitchell, the last thing I want to do just before signing off is sort of just recap and go into portfolio implications. And I guess the uncomfortable truth is you don't prepare for World War III by predicting the next headline. You prepare by building a portfolio that survives multiple outcomes. Okay. And firstly, for the retail investor, is our broad takeaway here today. And I think we pushed it earlier in this video is that markets don't really care about war. There's an initial drawdown where a few retail investors who are untrained think this war is the end of the world. And that sparks a sharp sell off, and the retail investor loses. So, the number one rule here is be patient and sort of keep your money involved. Don't just fear sell, don't lose out for that reason.
Yeah, definitely. Again, the headline risk and what you see on X or Twitter or you see on Instagram or you see all over CNBC is these big bold headlines of war bombings, videos, and so the initial reaction is probably pretty emotional for someone who's not um, too inclined with the markets, and you kind of
Yeah.
get spooked. So it's understandable, but you have to understand too that Wall Street doesn't care about it. At the end of the day, they want cash flows, they want earnings per share, and they want money in Americans or in your company's pockets. So when you think about it from that angle, it'll probably put your mind at ease. Now, if the war ever broke out into something that was nuclear or more aggressive, I would say it's a bit of a different situation, but as of
Yep.
right now, just be diversified, right? Energy, defense companies, not maybe commodities right this second, but if they ever have a drawdown, it's never a bad idea to have some of that in there and just kind of just be never too over leveraged in one sector, just kind of all the things that we've been preaching, right? So
Yeah. Another thing there is as well, I would also preach is figure out what your investment profile horizon looks like. Is it short term? Is it long term? Can you leave funds there and not really be too concerned about them? Because something that can be a loss over the next couple of weeks can still be a massive gain over the next year, right? Like we said with airlines, I think broadly speaking, your British Airways, your Delta, your Japan Air, whichever the company was, they sort of all fell between a 5 to 10% drawdown on the day. And if you hold them for over a year, or 2 years or 3 years. The idea here is that the activity and the volume is definitely gonna return. Like, you're gonna be back to where you started pre that market, so you don't need to sell your losers, and you need to just figure out, like, "Okay, it's not looking great now, but if this is a long-term hold, is it gonna be okay?" So just figure out that timeline.
yeah, that's a great point too. I think if you want to reference probably the most volatile backdrop for it was I think oil at the time, but it was also cruise ships and airlines was COVID, right? The world was
Yeah.
literally ending. Everyone thought you were stuck in your house and all of those stocks fell quite literally, I think 70 to 80%. And then ever since then, it's just been a steady grind up. They've all recovered. A lot of them went through all-time highs and they're cash flowing machines. So if it can get through COVID, it's gonna make it through this.
Yeah. The other thing as well here is you mentioned and touched on it is that diversification. What I would like to say here is geographically, I'd like to add to that. So diversification sector by sector, perfect. But you don't want to be too overexposed in an area, for example, the Middle East at the moment, where there's all this turmoil going on. You want to make sure you're nice and evenly spread out. And obviously at TLI, we advocate for a lot of Asian positions and we advocate for some EU positions as well. So just to make sure that your portfolio isn't too focused in sort of concentrated geographic areas.
Yep. No, well said. And again, the Korean markets have been going kind of nuts, and they pulled back here pretty sharply due to the natural gas,
Yeah.
and the worry of them not being able to export. But again, it's already subsided. You're starting to see the market kind of price it in and realize, okay, it's not as bad as initially thought.
Yeah, and then my probably last 2 points, just I know we covered them, but just as a review before leaving and a bit of a recap, precious metals, gold and silver, I would always recommend having some. So if there is a substantial pullback, no harm in adding. But right around these levels, I'd probably look for copper, nickel, palladium instead. And then in terms of cryptocurrency, I don't think it's a safe haven that people have thought it would be, that it would prove to be, because it's obviously an asset that's sold off as a first major asset class if someone needs to deleverage. But it's a nice little bit of insurance to have in your portfolio as a, you know, something alongside your commodities or your precious metals.
Yeah, well said.
So that brings us to the key takeaway from today's discussion. History shows that markets don't simply collapse during geopolitical crises, they reprice risk. Some sectors suffer, others thrive, and over time, capital flows towards the industries, resources, and regions that become strategically important. The challenge for investors isn't predicting the next headline, it's building a portfolio that can withstand volatility, adapt to shifting global dynamics, and capture opportunities when markets overreact. If there's one lesson from history, it's these periods of geopolitical tensions often create uncertainty in the short term, but for disciplined investors, they can also create some of the most powerful long term opportunities. So, on that note, thank you for joining Mitchell and myself today. That's everything from the team here at The Long Investor. If you enjoyed the analysis, make sure to like, subscribe, and we'll see you in the next video. Thanks.